This video is for people who are new to forex trading, beginners, newbies, people with a curious mind who are not sure whether it is a scam or it is something which is actually genuine. If you are new to this channel, my name is Joel Sam. Over here, I post the videos that will help you become financially free. I just need a big favor from you. Hit the like button, hit the subscribe button, and let's jump right into the video for today. So in today's video, I want to be focusing on establishing or explaining the very basic terms in Forex. I want to give a bird's eye view of what the Forex market is, what it entails, and how you can get into it. Okay, we'll skip how you can get into it for this video and get into details about that in the next video. Today's video is a very basic video. So if you are new to the Forex market, if you've been curious for a long time, grab your pen, grab your paper, and let's jump right into it. The terms we'll be explaining in today's video include Forex Trading, Forex Market, Forex Broker, MT4, MT5, Forex Signals, Entry, Stop Loss, Take Profit, Pips, Margin, Leverage, Buy Limit, Sell Limit, Break Even, every basic thing in Forex. So it's a mixed basket of the very basics of what you must know and understand about Forex. Let's jump right into it. What is Forex Trading? Now, the word Forex is basically a shortened version of the word foreign exchange, where foreign and exchanged have been put together to form Forex. Now, this involves the trading of different foreign currencies in a decentralized marketplace. Okay, so you are trading, for example, the cedi against the dollar, or the dollar against the pound, or the pound against the euro. So how do forex traders make their money in the market? How exactly do they make profit from this business? Well, it's actually easier than you'd expect, and I would like to use a very simple example to help you get exactly how forex traders are making their money. If the price of $1 is 5 cedi and I buy $5, that will mean I have spent 25 cedis to buy $5. This is foreign exchange. I have spent 25 cedis to acquire $5. Now let us assume that the price of the dollar moves up to 6 cedi, and when it moves up, I sell my dollars. That will mean that because I have sold my $5 at a higher price of 6 cedis, I will now have 30 cedis, meaning I will have a 5 cedi profit on my initial trade. This is the very simple explanation for how traders make their money. You basically buy low and sell high, or you sell high and buy low. With retail forex trading, the dynamics are quite different. What I've just explained is what the big banks and financial institutions do. But for retail forex traders like you and me, we are going to buy currency and wait for the price to go up before we close the trade. Now, because we would close the trade at a higher price, we would have made profit. If we sell the trade and leave it open, because we would close the trade at a lower price, we're also going to make profit. It is that easy. This is how forex traders make their money, from banks and financial institutions right down to simple retail traders like you and me. Now, what is the forex market? So as we've explained, forex is foreign exchange, and the forex market is that global decentralized system where this trading takes place. Now, with the advent of technology, we have decentralized apps or platforms that allow anyone like you and me to take part in this foreign exchange or this trading. And so this is what the market is. Anyone who is taking part in this trading is part of the forex market. It could be banks and big institutions. It could be retail traders such as me and you, with simple apps like MetaTrader 4 or Deriv on our phones, and executing trades to that effect. So that is the forex market, and that is forex trading. Now, what is a forex broker? A forex broker is a company, usually a financial institution, that gives anyone access to their platform for buying and selling currencies. That is basically what a forex broker is. It is a company that gives people access to their platform to buy and sell or to trade in foreign currencies. The traditional forex brokers we all know of are the banks. I mean, if you want to exchange your CD for some dollars or your CD for some pounds, you walk to your nearest bank and then you do that exchange. But with the advent of technology, there are decentralized platforms that have been created by certain companies, banks and financial institutions to aid in this process, okay? And these are the brokers, the forex brokers. Now, examples of forex brokers we have are Xness, IC Markets, Deriv, Tigerwit, Eagle FX, and what have you. Now, in the forex space, there are a lot of scam companies out there, so sometimes it can be hard to tell who is a genuine broker and who is a fake broker. I put out a video some time ago detailing how to identify fake brokers or scammers from genuine ones. I'll not go into details in this video. I'll leave the link in the description below. Go watch that video and find out all the information you need for yourself. So like we've explained, a forex broker is a company that gives people access to their platform to buy and sell foreign currency. Most of them come with brokerage apps that you can easily use on your phone to execute your trades, okay? That is to buy and sell currency. And so you just go to the app store and you download the app for whichever broker it is you are interested in. Now, because of international financial regulations, a lot of these brokers would require you to register on their platform before you begin to trade. They would need you to verify your identity and verify your address. These are all international protocol to ensure that Forex isn't being used as a front for money laundering or the sponsoring of international terrorism. Again, another thing you must know about brokers is that they are entities that connect retail traders, that is you and me, to the forex market, okay? The forex market is this huge platform where banks and big institutions are exchanging currencies on a very high volume basis. Now, these brokers give retail traders, ordinary people like me and you, access to this market so that we can also participate in the trade and make some good profits for ourselves. Now, the broker must be distinguished from the trading platform. What is a forex trading platform? There are so many of them which have been created by some brokers, but the very basic ones that almost all retail traders use are MetaTrader 4 and MetaTrader 5. These are platforms where you actually execute your trade. Now, when you create your brokerage account, your broker might not offer a platform for you to execute your trades. You may have to log into one of these traditional platforms, that is MetaTrader 4 or MetaTrader 5, with your brokerage ID details or your brokerage account details so as to execute your trades. You can have access to MetaTrader 4 on your computer. You can download the app on your phone or your tablet. You can do the same with MetaTrader 5. There are several other trading platforms. I cannot go into details. I'll leave their names on the screen so that you see them and you investigate. But for a beginner, the very basic platforms that you must know of are MetaTrader 4 and MetaTrader 5. This is where you would execute your trade. Now, I want to be very clear in the distinction between a forex broker and a forex trading platform. The broker is kind of your bank. The broker keeps your money. The broker facilitates the trade between you and the forex market. And the platform, MT4, MT5, is that platform or that avenue where you execute your trades, okay? It is where you issue commands that the broker can then take and execute in the forex market on your behalf. So that is the distinction. If you create a brokerage account with Xness or IC Market, it doesn't end there. You then have to go and enter MetaTrader 4 or MetaTrader 5 with the details you created on your brokerage account. Now, how do you log into MetaTrader 4 or MetaTrader 5 with your Forex brokerage details? Step 1. Download MT4 or MT5. Step 2. Log into your Forex brokerage account and create a trading account. We are using Xness for this example, so we go into Xness and we create a new account. You select MT4. You select your leverage. you name your account, you choose the currency, and then you set your password. Now, once this is done, there are two ways of going about it. You can go to MT4, look for the trading server, select XNES because XNES is where your brokerage account is. Now enter your trading account number, enter your password, and enter the platform or the server, and then log in. It's that simple. You can now begin to execute your trade from MetaTrader 4. It's exactly the same process for MetaTrader 5. Instead of selecting MT4, you can choose MT5 and then continue with the trading account creation process. The next thing we want to talk about are Forex signals. What are Forex signals? Forex signals are trading indicators created by Forex traders to guide interested people to participate in their own trades. Okay, usually a Forex trading signal will come in this format: buy, stop loss, take profit, or sell, stop loss, take profit. Sometimes you see take profit 1, take profit 2, take profit 3. Those are the complexities for advanced traders. This video is meant for beginners. So what you must be interested in is the entry price, which is the buy or sell, the take profit, and then the stop loss. This basically is what the signal is. There are so many signal platforms out there. The ones I recommend to you, my cherished subscribers, are Kojo Forex VIP and Serendipity Trading Academy. I would also recommend Lifetime Asset Trading. They are also quite good. So when you enter any of these groups on Telegram or WhatsApp, they'll post what we call Forex Trading signals. Okay, and the signal is basically a market call. It's a call for you to execute a trade at a particular price with certain take profit and stop loss parameters, okay, based on the market analysis of the trader who has issued out those signals. Now, I mentioned entry, stop loss, and take profit. What is entry? Entry is the price at which you execute your trade. It could be a buy trade or a sell trade. That price at which you enter the market is the entry. What is stop loss? Stop loss is the price that you set when you execute your trade, so that if the trade does not go your way, the market takes you out at a place that you don't lose too much of your capital. You lose just a bit of it, a very small bit of it. Now, the importance of setting stop loss cannot be overstated. It is so important in protecting your account. There are times that you enter a trade and you have to go about doing other things. You cannot sit by your phone or your computer monitoring the trade throughout, okay, because the market does not move just like that. It takes a bit of time to move in the direction that it is going, and so setting stop loss protects you in that event where the market suddenly reverses and doesn't go your way, and you're not sitting by your PC or you're not by your phone to get out of the trade and mitigate your loss. Take profit works in absolutely the same way. It helps you take advantage of the profit that the market will give you, assuming you were not sitting by your phone or your computer. So take profit is also very important. It sets the level that you want the market to close the trade in profit for you. If you don't set take profit and you leave your trade running, you go about doing your daily duties or your daily affairs. By the time you come back, the market would have probably hit the point that you would have intended to take profit, but then reversed, and so you would have lost on the opportunity to take profit from the market when the opportunity did present itself. Very simply, that is entry, stop loss, and take profit. I hope it has been very, very clear. The next thing we want to learn about are pips. What is a pip? You hear a lot of Forex traders talking about pips. If you are in Kojo Forex VIP or his community, you see him post 110 pips running, 80 pips running, 30 pips running. If you're in Serendipity Trading Academy, any of their pages, you see that sometimes they post 1,000 pips running, okay, 400 pips running, or 200 pips loss, or 50 pips loss. What exactly is this animal called pip? Now, pip is an acronym for percentage in point or price interest point. A pip is the smallest price move that the exchange rate can make based on Forex market conversion. The pip represents a tiny measure of the change in a currency pair in the forex market. It can be measured in terms of the quote or in terms of the underlying currency. A pip is a standardized unit and the smallest amount by which a currency quote can change. So when the price changes from this to that, then it has moved up 1 pip. If it changes from that to this, then it has moved down 1 pip. So if you've taken a buy trade and the price moves from here to here, then we can say it has moved 10 pips in profit, or 20 pips in profit, or 30 pips in profit. The pip represents that smallest or minutest change in the price of the currency. Now, what is margin? You hear about margin when you open your MT4 or MT5, you see margin as well. The truth of the matter is that you cannot execute trades with very small amounts of money, say $10, $100, or even $1,000. It is woefully inadequate to see any meaningful returns on the trade you are taking. What margin does, therefore, is that it gives you access to the funds of the broker so that you can take bigger trades. Most of us retail traders trade with margin. Even those who are into stock trading also trade with margin. There are a lot of arguments against margin because in as much as it is helpful in maximizing your gains in the market, assuming the trade goes against you, you can end up losing so much money and losing so much to the broker. It is essentially the amount of money that a trader needs to put forward in order to place a trade and maintain that position. Margin is not a transaction cost. It is a security deposit that the broker holds while a forex trade is open. Trading currencies on margin enables traders to increase their exposure. When trading forex, you are only required to put up a small amount of capital to open and maintain a new position. This capital is what is known as margin. For example, if you want to buy $100,000 worth of USD GBP, you don't need to put up the full amount. You only need to put up a portion, like $3,000. The actual amount depends on your broker or CFD provider. Margin can be thought of as a good faith deposit or collateral that is needed to open a position and keep it open. It is good faith assurance that you can afford to hold the trade until it is closed. Margin is simply a portion of your funds that the forex broker sets aside from your account balance to keep your trade open and to ensure that you can cover the full potential loss of the trade. Now, this portion is used or locked up for the duration of the specific trade. Once the trade is closed, the margin is freed or released back into your account and can now be usable again to open new trades. Margin is expressed as a percentage of the full position size. Now, because we want to keep this video short, we wouldn't be going into too many details. I'll leave the link to a very helpful resource in the description. It's called babypips.com. A lot of forex traders actually know about babypips.com. It gives you a bird's eye detailed view of the forex market, and everything I have mentioned in this video will go into much detail on babypips. Now, leverage works hand in hand with margin. It refers to the ability to control a very large amount of money using very little or none of your money and then borrowing the rest. So if you are trading with leverage, what is happening is that you are borrowing the broker's funds using very little of your own capital to execute the trade. Okay, that percentage of your capital that you are using is what is the margin, as we've explained, and the rest of the money that you have used in executing the trade is the leverage. Now, leverage is expressed in ratios. Anytime you are creating a trading account, you see them ask you to choose your leverage. It could be 100 to 1 or 100 to 2 or 200 to 1 or 50 to 1 or 1000 to 1. It is expressed in ratios. Now, if your leverage is 100 to 1, what it means is that you are controlling $100,000 with $1,000. Anytime you take a trade that controls $100,000, you are using $1,000 of your own capital to execute the trade. Now, using a very high leverage also gives you the opportunity to enter multiple trades on MT4. If you are using XNet, for example, if your leverage is high, you are able to execute more trades at a go. If your leverage is very low, you can only execute 1 or 2 trades at a time. Now, leverage is a double-edged sword. While it gives you the opportunity to make so much money from the market, if the trade goes bad, it can also leave you heavily indebted to your broker, and you lose more and more of your money. This is why anytime you take a trade and it is going bad, you see that your funds seem to be going away faster than if you were running in profits. It is because the broker has to take more and more of your capital or the margin in order to keep the position open for whenever the trade will decide to go into profits. So you need to use leverage diligently. If you are using a very small account, please keep your leverage low so that you protect your capital. If you are using a big account, you also have to use leverage in moderation. Otherwise, you end up putting yourself in big trouble. Usually for $100 to $200 account, I suggest a leverage of 200:1 or 100:1. If you are daring enough, you can try 500:1 so that you can execute more trades at a go, but it is very, very risky to do so. Now, if you are controlling funds which are $1,000 and above, you can raise your leverage a bit, but still be cautious. Do not go overboard to something as crazy as 2,000:1, because there you know that you have put yourself in serious danger should the trade go against you. Finally, we want to talk about buy limit and sell limit. I've created a very short video on that, so I'll not go into details. But basically, buy limit and sell limit is used anytime the market has not yet reached your entry price. For example, if you want to buy gold at $1,800 and the market is currently hovering at $2,000, what you do is you use a buy limit to enter the trade so that the order is there pending, and then when the market comes to hit $1,800, it executes the trade on your behalf. This is very useful so that you don't have to sit by the chart or by your trading platform the whole day waiting like a vigil for whenever the market is going to hit your entry price so that you enter the trade. The buy limit or the sell limit gives you the opportunity to execute your trade so that once you are not there, when the market reaches the price for which you want to buy or sell, the trade is executed on your behalf. Very simply, that is what the buy limit is, and that is what the sell limit is. What is a lot size? A lot size represents the units of any currency. We have the standard lot, the mini lot, the micro lot, and the nano lot, where the standard lot represents 100,000 units of that currency. The mini lot represents 10,000 units of that currency. The micro lot represents 1,000 units of the currency, and the nano lot represents 100 units of the currency. This means that if you are placing a trade and you use one standard lot, or the standard lot, which is 1.00, you have taken the trade with 100,000 units of that currency. So if you have taken a trade with the US dollar, you have taken it using $100,000. In the same way, if you take a trade with the mini lot, which is 0.10, you would have used 10,000 units of the currency. And so if you were trading with a dollar, that would represent 10,000 US dollars. If you took a trade with the micro lot, which is 0.01, it means that you would have taken the trade with 1,000 currency units. So if it were the US dollar, that would represent 1,000 US dollars. If you take a trade with a nano lot, which you will not find on many brokers but on some, that is 0.001. If you take a trade with that, it means you are taking the trade with 100 units of that currency. So if it is the US dollar, that will represent $100. So it's simple. This is what the lot size means and what each of them represent: the standard lot, the mini lot, the micro lot, and the nano lot. Now, if you have a very small account, something that is less than 1,000 US dollars, you should as much as possible stick to using at most the mini lot. Don't go to the standard lot, because if you go to the standard lot, you are asking the broker to give you $100,000 to trade with, which means that if the trade goes bad for you, you are going to owe the broker a lot of money. If you use the mini lot, it's manageable. If you use the micro lot, it's even much better. Okay, that represents just $1,000, and so you're kind of cutting your cloak according to your cloth, or living according to your means. Okay, so this is, if you ask my suggestion, my personal suggestion about it, I'll say that from $100 to $200, stick to using the micro lot. From $200 to $1,000, the maximum you should reach is the mini lot. Don't go above the mini lot. And if you have about $1,000, you can safely use the standard lot, but even there, be very careful. Don't take too many trades at a go. Use it for one trade at a time. Okay guys, thank you so much for watching this video. I hope I have explained these basic things to the best of my ability. If I confuse you any further, I am so sorry. You might want to smash the like button so that I do better in my next video. If you did enjoy this video too and you feel that it was extremely helpful, hit the like button as well. It will go a very long way to help me making more videos such as this. Thank you again for watching, and I'll see you again in my next video. Peace out.